Well, good afternoon, financial professionals. My name is Jennifer Nadeau, Case Design Specialist here at E4 Insurance Services, welcoming you to The Brew, building relationships every week. For those of you tuning in today for the first time, welcome. We like to start out the Brewcast by celebrating what today's National Day is. And today is National Maryland Day. Hello to our friends in Maryland. It is deliciously National Peach Pie Day. And also equally as delicious, it is National Waffle Day. So some great days to honor today. On today's Brew, we welcome John Jacobs, Senior Vice President of Business Development at Libra Insurance Partners. John will be sharing with us how 2022 continues to be a year of extraordinary change for the U.S. life and annuity industry. He will discuss his thoughts regarding some of the major trends in underlying demand, the relationship with the wealth management industry, the potential impact of mergers and acquisitions in brokerage, as well as what we may expect from private equity's increased role within the industry. As a reminder, please feel free to use the chat box to share your thoughts or ask questions. And also, all attendees are in a drawing for a prize today, and we will announce the winner at the end. Before I kick it off with John, Dan, welcome to the call. I know that you're on and would like to give some opening comments as well.
Well, thank you, Jennifer. I'm looking forward to my wife telling me that she is making a peach pie today. So I can't wait to try that a little bit later this afternoon. But I did want to say welcome to John Jacobs. We also have Michelle Lemming on from Libra, and we're one of 62 agencies that are partner agencies together that form an organization called Libra. And together in life insurance business, we represent about 20% of the U.S. life market share. And so it's a great organization that really contributes a lot to our success and for our ability to continue to grow and have access to some of the very top carriers in the life insurance providers in the country. And John's really got his finger on the pulse of the industry and where it's going and the business development side of things. And so I'm looking forward to him sharing today. And I just wanted to open it by saying, I'm looking forward to a great brew, and as you lead John through some questions, looking forward to his insights, and thanks for Libra being such a great partner for us as well.
Excellent. Thank you, Dan. And John, welcome to the Brew. We're really happy to have you on today. Let's jump into it.
Got it. Let's go.
Yeah. My first question for you, and it's really a two-part question, and it's surrounding the baby boomer generation. Many people in that generation they're either in retirement or they're right at the cusp of or near retirement. How is that impacting our industry right now, and how does it affect the demand as well?
Jennifer, it's a great question. Obviously, as we know, the boomers control somewhere in the neighborhood of 70 to 72% of the investable wealth in the United States, which is really a shocking number when you consider literally the trillions of dollars that are set aside in savings, that they control that much of liquid assets. That doesn't take into account things like equity in people's homes. But as we've all seen, everybody on this call, we've seen probably 10 years worth of survey data that demonstrates that the boomers are primarily concerned with, it usually falls within their top three concerns, outliving their assets and or having some sort of shock to their assets or their income in retirement tied to healthcare costs. So I think the insurance industry has done a very good job in highlighting that that need and that demand from the baby boomer generation. And certainly we've seen that as an impact in products that address it directly, notably things that are tied to financing of long-term care benefits.
Mm-hmm.
But the shift in assets, I think, is notable. Certainly when we look at capital flows have been shifting away towards fixed income for some time. We've heard the concern that our industry and capital markets in general, but certainly wealth management has had over the 60-40 being inadequate to address income needs. So that second, demand of baby boomers, which is not to outlive their assets, is something that the insurance industry is poised to take advantage of directly. To quote Larry Fink, who's the CEO of BlackRock, and Larry only manages a teeny tiny $5.5 to $6.5 trillion at this point. He said that they will create products that mimic what insurance companies do, but that they will stop short of setting up and operating an insurance company because that's not the business they're in. And what he was talking about, Jennifer, are guarantees. That ultimately a big part of what the boomers are looking for are guarantees against income, guarantees for principal, and guarantees aside for legacy concerns as well. So BlackRock has a return on equity somewhere in the neighborhood of 28 to 35%. Insurance companies have returns on equity much lower. So I think that might have something to do with why Larry went out and cut a deal with two large insurance companies to put income guarantees around their target date funds. They cut those deals with Bright House and with Equitable a little over a year ago.
Mm-hmm. Excellent. Thank you for that, John. Pardon me while I look at my notes here, because our next topic is about the register investment advisor model. And I really wanted to get your comments or thoughts about the relationship with our industry really flipping to the RIA model. And I recently read, and that's what I'm going to cheat on here, is that it's been one of the fastest growing categories in the wealth management market, where instead of advisor-centric wealth management model, firms are focusing on these advisory services earning recurring fees versus commission-based revenue. And it's a big topic. I read about it a lot. I see it a lot. So why should we care about this, and what can we do about it?
The RIA model, I would argue, and I know I'm dating myself outside of my ever-present gray hair, it has really been a great model for advisors, probably since the mid-90s. The fact that it has taken off in popularity speaks to the fact that there are so many tools that allow an individual advisor or group of advisors to set up a very, very rich offering that they can then control. And of course, part of, I think, what you're talking about, Jennifer, has been not only the rate of new firm formation in RIAs has far outpaced any other segment of financial advisor in the United States by pretty sizable margins. And that's been simultaneously with this record-breaking pace of consolidation or M&A activity going on inside of the RIA space. So that tells you, as firms have been buying each other and consolidating, we're still seeing net new firms grow at an unprecedented rate. That talks about the popularity of this platform. I think it also certainly inside of that popularity talks to the economics of the platform for the advisors and their owners. Really by almost all metrics, you're looking at a 30 to 40% increase in EBITDA across those platforms, if you don't mind the generalization. But for the insurance industry, it really means meeting wealth managers where they are. And more, as you said, that's on an RIA platform. The interesting thing is that since so many folks are leaving the wirehouses, leaving banks, even to some degree, independent broker dealers, or maybe the independent broker dealers are really simply changing their offering to accommodate RIA platforms, we're seeing demand on brokerage firms for life, annuity, and long-term care, grow in the aggregate, and that's across all product sets. And then certain things are growing that are noticeable as well, notably what we call point of sale, which is where brokerage firms are asked to more and more be client facing as more and more of these wealth managers are squarely focused on wealth management, and for that fee-based asset management more than anything. And they're asking for a specialist to come in to handle the life insurance, the annuity, the long-term care, and disability. So yes, certainly we as an industry, and the carriers are trying to create product for the RIAs as well. I would actually argue the jury's out on that, but it's interesting to see the carriers certainly make efforts to have fee-based insurance products as well. And last but not least is this growth in these hybrid offerings that sometimes are referred to as outsourced insurance desks, where we split up the asset management or advisory component from the insurance product selection, which charges a commission, and allow those two to operate by two separate entities.
Excellent. That is a new concept to me that I'm going to have to do some reading up on. So thank you for that. And you had said this in part of your answer early on. It definitely brings us to our next topic as well, and that's one of mergers and acquisitions, or M&A. And what I really like to focus on is the potential impact on brokerage. In a conversation, that you and I had, you quite appropriately described it as the pink elephant in the room, and it really is. And we in the industry are hearing about it all the time. I'm hoping that you can answer for us what this means to the industry. And Dan and I were chatting a little bit too, and he had mentioned to me, there's also private equity purchasing agencies as well. So hoping that you could speak to us on that topic too.
Well, although I can't certainly speak for every acquirer or their principals, if we don't mind some generalizations, then I would answer it this way. First and foremost, I think, at least on the supply side, this has a lot to do with two things. One, the very first question you asked is that the demographics are very attractive to our industry, really for the next 10 years, thanks to the baby boomers. And private equity sees that. Private equity is oftentimes, and we'll leave venture outside of this, but really talking about traditional private equity, leveraged buyout strategies, that private equity sees big demographic moves, big consumer moves, and that's part of the reason they want to get into this space. Certainly the cost of capital has been fuel on that fire. So I would argue that demographics, certainly the attraction to what's been traditionally a fragmented space in brokerage. There's a handful of companies that are quite large, but overwhelmingly, it's a really fragmented space. Now, I'm not to insinuate that the only thing that's available to private equity is like a roll-up strategy, but certainly we've seen a handful of acquirers do a number of transactions, and many of them by two of these companies in the past 2 years. Cost of capital, again, has made it easier for them to do richer deals. And I think that is the other part of this, Jennifer, too, which is that for a lot of owners of brokerage firms, traditionally to sell their firm was to sell to existing partners, perhaps, maybe to a third party, oftentimes involving bank debt. And those terms may involve multiples in the 5 to 6 range of earnings and a payout over 5 years, possibly even 7 years. All of a sudden, we've got acquirers who are coming in who are talking about multiples in the 10 to 12 to 16 range of earnings, and that they're willing to pay cash up front 50 to 70% of the entire transaction and the rest of it on a 3-year earnout. So for sellers, this has really been an unusual market, almost to the point that if a seller doesn't have a conversation at these valuations, it would almost be irresponsible for them not to listen. But as you can also imagine, Jennifer, as we talked about, certainly a lot of people are not looking to sell. Part of the logic is, since the market's going to be so good for so long, why would I want to sell my business to someone else so it can be part of a roll-up strategy for a private equity owner? Mm-hmm. So that's certainly the other side of saying no thank you.
Is this good or bad? I mean, can you even quantify it like that?
Right. That's probably where I I would love to add the most value, but I'm also missing that crystal ball that should come along with the question. I think the jury's out. There's an element of our industry that I know personally, to say to everyone I love in our business, and that it's incredibly entrepreneurial. Really, owners of brokerage firms pivot and move very quickly to meet the needs of financial advisors, even traditional insurance agents across the United States with varying circumstances that they need. They do a great job of meeting their advisors where they are. Historically, large corporate ownership of these companies that eventually get consolidated to the point that they're, if you'll mind expression, books of business, don't have the same sort of service quality that these entrepreneurial owners have. And eventually the owners will fade into the sunset. So I would say my concern is around corporate ownership and service delivery versus entrepreneur ownership and service delivery at the least. At the same time, certainly bigger balance sheets do offer a degree of stability. And to the extent that some of these companies will go public, in the near term at least, they will bolster their balance sheets with public offerings. After that, the other thing we get into is ownership of a publicly traded company and the demands of the street. As we all know, the street is incredibly demanding. They're going to give you a nice big multiple on your stock, but they're going to want their earnings each and every quarter without really too much in the way of excuses for why it didn't happen. So it's a different kind of pressure that it brings to bear.
Excellent. Thank you. And I knew that was not a tricky question, but one that would not just, yeah, it's good. No, it's bad. So I appreciate that. Let's open it up for question 2 now. So I'd like to remind everyone that they can unmute their line, or you can definitely ask a question in the chat box. But while we're waiting to see if there are any final questions, I'd like to remind everyone that today's brew and our full library are recorded and they're shared on the brew blog on our website, which is www.e4.insurance. And let's also take a couple of moments to do our giveaway. John, I will give you the honors if you could pick a number between 1 and 18.
How about 12?
Number 12. Chad Lindgren is our winner. Congratulations, Chad. Be on the lookout for a complimentary CE voucher and a Starbucks gift card that will be coming your way from all of us at E4 Insurance Services. So congratulations. Let me take a look at the chat box here to see if there are questions. And also, as a reminder, you can certainly unmute your line too. I do have a question in the chat box, so thank you for that. And the question is, should an advisor be concerned with private equity investment in a carrier? Or should a client worry about it? Worry about that?
Yeah, it is a great question. In some 30 plus years in the industry, I've never seen this much outside capital come into the carrier side of our industry. It's actually astounding. The reasons for private equity coming into it, certainly part of it has to do with the demographics we mentioned before. Ultimately, for the largest private equity funds, and at the top of that list is certainly Apollo, Blackstone, Carlyle, and others, is that this really represents the closest they've gotten to a form of permanent capital that they've been seeking for 25 years. Back to your question, the jury's out. On one hand, private equity will absolutely source investments from really their private equity side of the house back to the insurance company that they own, and source deals for things like asset-backed securities, other forms of really private corporate credit that the insurance companies may normally be the last bite at the apple of those deals. And those deals can be incredibly lucrative for accounts, for crediting rates, and for guarantees to policyholders. At the same time, if private equity is too aggressive with some of these deals and these asset allocations, that's a concern in terms of liquidity and their ability to meet the guarantees that they post. I would say this to you. It is not in anyone's interest, and that includes in any of the large private equity funds, to ever see a carrier become restricted in their ratings. So they're very, very sensitive to what they invest in, and especially credit quality going to the insurance companies that they own.
Yeah, and there's a second part to that question that I'm reading, and I think you might have touched on it. And does that kind of ownership force insurers' capital accounts to take higher risks than they might otherwise do?
That's really a good question. And I think we can give a real life example. Is that Apollo, which created and owns Athene, they actually merged with Athene because it's so attractive to them, competes heavily, as you all know, in the fixed index annuity space. And they're competing directly with Allianz of North America, who's pretty much the 800-pound gorilla in the FIA space, owned by its parent, Allianz SC. Allianz is in many ways still as the leader of that, but they've been forced to respond at times, seemingly to market pressure, not only from Athene, but some of the other private equity controlled FIA carriers. And would Allianz tell you it's good or bad? They would say it's competition, right? And it's forcing them perhaps to issue not only rates, but also features in their products that they considered maybe they do those features more quickly because Athene and Apollo can respond so quickly. Ultimately, I think from a product feature and crediting rate standpoint, the competition is good. I think the other thing to consider, as Dan mentioned, is about life insurance, is that for life insurance, it may force the carriers to look at if you'll excuse the air quotes, a capital light strategy, where they're able to go out to reinsurance more, lower their retention, so that they can move faster and be more innovative on product design and issuing a lot of the guarantees that advisors and clients want.
Excellent. We do have another question in the chat box here. And how do the approaches of two major players in the BGA and M&A space vary? And how does that impact the end users, the retail agents and advisors?
It's a good question. I think the pink elephant in the room, to go back to Jennifer, to your point, your question, in this case is integrity. Integrity has grown dramatically in the past 18 months with a series of transactions that very quickly took it out of the final expensive med sup wholesaling area and squarely into this area, life and annuity brokerage, primarily in support of wealth management and property and casualty brokerage. And I think integrity, as it looks today, it's hard to imagine the company will not go public. It's hard to imagine that their private equity investors will obviously need an exit in order to see a return on their investments. Silver Lake put in some $1.2 billion of cash into integrity. I can't imagine they see a return in the absence of an IPO. What does that mean for advisors? The jury is out. Integrity is investing heavily in technology. We do not know how that's going to pan out at the end of the day. They're certainly now working in what I would characterize as almost 4 separate verticals. One is really in final expense. Another is in our business. They are doing some work in really the multi-level marketing, I should call more mass market-based approach in their acquisition of PHP. And their acquisition of Annexus about a month ago squarely puts them into product design. And I think most of us believe that at some point in time, Integrity will likely have proprietary product, probably annuity product. Hard to say on life. And so those are 4 separate verticals. Will they complement each other? Will they deliver good service? The jury's out. We really don't know.
Thank you for that. Dan, I see that you've appeared back with us. Do you have any comments or closing comments before we start to close.
Yeah, John, I just wondered if you had any thoughts. Private equity typically needs to monetize it at some point so that they can reinvest and go after the next growth phase of their cycle. So do you have any thoughts on how an Integrity, for example, or some of the other aggregators plan to monetize this? Because they don't usually buy and hold for a long period of time. That's not their strategy.
Yeah, they're not great coupon clippers, are they? Right? That's not their strategy usually. In the case of Integrity, Dan, it's hard to imagine that they don't do an IPO. And part of that, the degree of certainty, at least my opinion, is based around now is tied to scale. It's not only the amount of money that their last private equity investor put in their last round, but it's also at $1.2, $1.3 billion that Silver Lake put in. I don't see any other way that Silver Lake alone can get their returns minus an IPO. Some of the others, I think it's while an IPO is certainly part of their possible exits as well, or monetization, I don't think we see carriers looking to acquire these firms. It is possible that banks would look to acquire them. As most of you know, Crump is owned by Truist, and certainly I would think that Truist is very happy with their ownership of Crump. So in that line, I think banks are possible buyers. Last but not least, there's thought, Dan, that again, Integrity, we can see this, I don't know about some of the others, that eventually they would want to build proprietary product around their distribution, with the idea some of that distribution would be biased to that proprietary product. That still doesn't get you the kind of multiple you need on a private equity investor. So IPO or sale, I think, is their only way they can go. Well, I'm sorry, I guess the last answer, Dan, too, is a recap, right? Recapitalizations are a way to at least take your money out to at least get your basis back.
Yeah, right. Well, it's good to know there's still good independent firms that are growing and thriving in this space and still meeting the needs of advisors and bringing, as we say every day, crafting better financial outcomes for our financial advisors and their clients. So thanks, John, for your contribution. Jennifer, great job.
Thank you. Thank you so much, Dan. Thank you so much, John. This was a great call, lots of great information. And I foresee you being a guest on the Brew again, probably in the near future. So we really appreciate having you on the call today.
My pleasure, Jennifer. Happy to come back, and everyone at E4 doing a great job. I've also been told if I really want to get in good with E4, I will come up and visit sometime in February in Fargo. That'll demonstrate my level of commitment to E4.
Yes, it would demonstrate your level of commitment. Thanks again for joining us today, and congratulations, Chad, for winning the drawing. Tune in next Wednesday as Julie McNeely, financial representative from McNeely Financial Services, kicks off LIAM, or Life Insurance Awareness Month. And we'll be having a special 30-minute brew with Julie. Julie will answer the questions of why does risk matter so much and how do we help clients evaluate it? Julie believes evaluating risk should be something everyone does on a consistent basis. She will share an idea for you to assist your clients in that process as well. Sometimes we are so focused on helping our clients manage risk on the investment side that we forget to review the income and expense risks our clients may face. And what a better way to kick off Life Insurance Awareness Month than to see the power life insurance brings to the table and helps clients transfer risk. So we're looking forward to that. Thank you, everyone, for joining. Have a great rest of the week, and we'll see you again next week on The Brew.